Hi, this is Denver Noes with Wealth for Life. This is part 2 of our discussion of comparing whole life with indexed universal life. And in the last video, we kind of discussed the internal rates of return of some policies over a 20-year time frame. This particular number is on the whole life side. Was put together by a whole life company comparing themselves to 8 other whole life companies. And that's the internal rate of return they come up with. And then we also did the comparison of the internal rate of return on the index side. Internal rate of return is the real number you want to look at after fees and all the costs are taken out. But I wanted to go into a little more detail of what can go wrong, on both sides of the equation here. So one of the things when you look at that internal rate of return, it's based on current assumptions, is what they call it in the insurance world, or they're basing it on an estimated rate of return. In this case of whole life, the estimated amount of dividends that they're going to be paying. So if that number doesn't perform based on what they're projecting it, that can change the whole picture. And that's one of the things I hear, I would say a lot with whole life policies and clients that bring them in, is they had this idea that they were going to pay premiums, and then at some point the policy was going to build up enough cash value that they would not have to pay the premiums anymore. Or something happens where life happens along the way and they're not able to pay into the policies anymore, and then the policies start having problems whether they become in danger of lapsing. The reason is because it's based on that hypothetical number of what that's projected. And there's an interesting study that National Underwriter did comparing 1987 to 2007. They looked at the hypothetical numbers, the current assumptions that whole life companies were using, the top 3 companies in their study, and they found that the projected number that they were estimating would be a 7.0 or 7.7% number is what they were estimating in their illustrations that the dividends were going to do. But what they found the actual number to be was actually, I think it was 4.62%. So quite a bit lower than it was actually projected. Actually, I think that's right. I think it was 4.79%. So it ended up being about 38% lower, than what was projected. So that's what happens is that the actual numbers don't come out to where their projected numbers were. Now you have an illustration that's showing, hey, your policy is going to run out because you're not adding enough cash and you have to add more, or you have to make changes to the policy. So that can certainly become a problem when the projected numbers don't match the actual, and there's some historical data that has shown that's happened. That was a National Underwriter study. If you want to Google that, or I'm happy to send it out. Now what can go wrong on the index life side? Same thing, where you're basing an assumption, historical rate, based on, say, an annual point-to-point strategy with a 0% floor and a 14% cap, as one example. That cap is going to yield a certain historical crediting rate. And so if the insurance company goes out and changes the cap and lowers it, and you're projecting 7% before with a 14% cap, and now they lower the cap to 10%, that internal rate of return is going to go down, and consequently the amount of income you're going to be able to pull out if you're using it for income is going to decrease. So what you do to protect yourself on this side of the coin is just to look at the crediting history and cap history that insurance companies have. Most good companies will publish their cap and renewal history, and you can see a trend. What did they do over the last 10 years? Did they change them very much, both for new business and both for in-force? So that's a good thing to look at. Next thing it's very important to look at in both of these policies is the loan provisions. Because a lot of people are buying them to use them for the be your own bank concept or the infinite banking concept, using them also for the liquidity provision, just being able to access money when you need it. So knowing how the loan provisions work is a very good thing to look at, and they work differently with both in comparison of whole life versus index life. So if we start with the whole life side, regarding loans, what's going to happen most of the time is it's going to be different for each company, but I would say if we look at the most popular whole life carriers out there, most loans are going to be at the 6 to 7% range. So that means when you borrow money out, that's the stated rate that you're going to pay. It'll say that inside the policies, usually says it in the brochures. Now the hard part about this is there's kind of a gray area I've noticed among the discussions among agents and even the whole life insurance companies themselves. I've talked to a lot of agents that will say, well, some of this is going to be offset by the dividend payments. Some of them will say it's going to be, the majority of it, and then I've seen the insurance companies come out and say, no, the dividends don't really offset it that much. This is actually the loan cost. So that's something you got to look at very carefully, is how they're actually calculating it. But either way, the stated rates you're going to pay on loan rates are going to be in that 6 to 7% range. Most companies, some might have a 5%, some might be a little above 7%, and there's usually going to be a provision 10 or 20 years down the road where those loan rates can drop. Sometimes they don't in some companies and some policies, so that's an important thing to look at. On the IUL side, most companies are going to start out with a loan at about 0.25% on the high end, on the low end, and about 2% on the high end as far as the stated rate for standard loans. So already they're much lower just on Indexed Universal Life. It was more designed with those low-cost liquidity features in mind. And then at some point, usually I would say the soonest is at about 5 years, or certainly most all companies go at about 10 years. Those loan rate's going to drop to 0%. Now the reason why is whole life, loans percentage is higher. Well, because you have more of a guarantee over there. So if you're taking money out of the policy, that's going to make it harder for the insurance company to guarantee it. So consequently, they're charging more for you to pull money out. Indexed Universal Life still has guarantees, but less of a guarantee than whole life. And it's designed, I think, really more with that liquidity feature in mind, being able to pull money in and out at a lower rate. So if I was going to do the infinite banking, or bank on yourself concept, I would tend to use Indexed Universal Life because the loan rates are stated at a lower rate. Now, there's a lot of whole life agents out there that are certainly going to disagree, and they will make their case that whole life's going to be better, and in certain situations, it certainly could be. The next type of loan that you have on Index Life is called participating. So a participating loan means that I can pull money out, the money gets to stay in the index, and I still get to earn any interest that's above my loan rate. I can make the spread. So most companies will have a loan rate of around 5%. Some of them will have variable, some of them will have fixed. I kind of like the ones that are fixed, but the variable ones have their place as well. So this means that if I'm using a 0% floor and a 14% cap on the S&P 500, and the S&P has a good year and goes up 14%, well, I get to make the spread. So this means if I pulled out $100,000 out of my policy, I use the participating loan, S&P goes up, I make 9% on that $100,000 even though I've taken it out and spent it, which I think is a pretty good deal. It's a pretty good way to leverage money. Now, of course, what's the problem with that? Well, the problem is that the markets could not go up. So if the index goes down that year, I earn 0% interest, then I'm going to pay the loan costs. I'm going to pay 5% for pulling the money out. And I would say that's what certainly a lot of whole life agents and a lot of index life agents don't like about participating loans. But the flexibility exists to actually switch between loan methods, which I think puts you kind of more in control. That means that if I'm sitting here, the markets are all-time highs, I have $100,000 out on a loan, I can keep it all in this zero-cost loan. Let's assume I'm past year 5. It doesn't cost me anything, my loan is out. Next year the market falls 30-40%. I'm looking at that and going, you know what, I'll take a little bit of risk. I can sweep my entire loan balance, that $100,000, into the index. Index goes up, I keep everything above 5% subject to this cap. Then the next year I could say, all right, I'm going to take my gain. Boom, I can switch that entire loan balance back across to the fixed side and take the 0% loan. So there's a lot of flexibility to do both, but the participating loan, and there's actually a whole video I have on this that, there's some pretty good data that shows you can have a fair amount of certainty using a participating loan with an index crediting strategy, and you can increase your income by 30 to 40% using that strategy. So, but one thing you do want to look at is if you have existing whole life policies that have loans outstanding, and you're paying these big rates, 6 to 7%, you actually can 1035 those policies into an index universal life. Some insurance companies will accept them, some won't, but to the point where you can go from paying 6 or 7% interest to 0.25% and then have that 0% loan kick in as soon as year 5. Can really reduce the interest costs that you're paying if you're not planning on paying the loan back. Now there's some downsides to that strategy because when you move over to a new policy, you're going to have new policy loads, new charges. So you really have to do a detailed comparison, and the way to do that is you get an in-force illustration on your whole life policy, and then you compare it to an index life policy and really look at the numbers closely and see if it makes sense. Same thing goes with just a whole life policy in general. If you've had a policy for 20, 30 years, a lot of times the insurance costs, the mortality tables have come down, cost of insurances have come down. So, and maybe your goals have changed. Maybe you didn't want particularly a policy that was going to just be for death benefit. Maybe you wanted more income out of it. Take that policy, get an in-force illustration, and then compare it to an index universal life policy and see if there's more advantages or see if you can use your money in a more efficient way. Sometimes it will work, sometimes it won't. And you really have to evaluate it, like I said, because whenever you move policies, you're going to have new costs and charges. But very often, with some of the advantages, you might, have your needs be able to get met better with a different strategy. So if you want to get more information, keep watching this video series and send us any questions that you have. Thanks again for watching.